Hi, everyone, and welcome to this latest instalment of the UK and a Changing Europe Economics panel. I imagine most of you have been to these before, but I'll just quickly introduce our panel. We've got Gemma Tetlow from the Institute for Government, Jill Rutter from UK and a Changing Europe and the Institute for Government, Ben Chu from the BBC, and last but not least, Jonathan Portes of UK and a Changing Europe and King's College. We'll follow the normal structure for these things. That's to say, I'll kick off with a couple of questions, but do stick your questions in Slido that I can put to the panel, and please do vote for the question that you want me to put to the panel, because the more questions they are, the harder it is to keep track, and I will pick the most popular ones as a rule. But thanks everyone for doing this. And just to start off, I mean, as a non-economist, I'm sort of perpetually confused by the debate about the state of the UK economy, particularly what strike me as conflicting claims about how well it's doing comparatively. So some people talk about the fact that we've had the fastest growth amongst developed countries. Others point to the fact that we haven't recovered back to pre-pandemic levels yet. What is the truth in comparative terms? How is the UK economy doing compared to other advanced economies at the moment? Any of you?
Well, Anand, I can start if you like.
Yep.
I think just looking at the levels, which I think is always the most sensible way to look at it, because growth rates, if you've had a very deep slump, you can get very quick growth, but you're only back to where you were. So looking at the levels of the UK output GDP relative to other G7 countries, the latest data suggests that we are still about 0.4% below, whereas the rest of the G7 are above it. So from that perspective, which I think is probably the most relevant comparator, we are doing worse than the rest of the G7. And it's not, from what I've seen, and Gemma and Jonathan and Jill may have seen other stuff, but it's not entirely clear why that is. There's various theories going around. I read a very good analysis of this just yesterday by the team at Pantheon Macroeconomics, which pointed out that looking at the expenditure breakdowns of relative different countries, it seems to be that the UK gap is mainly due to household spending, lower household spending here. So that raises the question of why might that be lower? They point out that, you know, it may be something to do with energy prices. We use quite a lot of gas relative to other countries, and that's obviously been rising very fast because of the energy crisis. They haven't risen as fast in the US, so that's one of the less of a drag there. They also point out that core goods prices in the UK have been relatively higher than European countries, and they say that possibly a Brexit effect there, although that's a bit tentative. But what's quite interesting is also that they point out that the UK savings rate has not fallen as rapidly in other countries in the G7. That's obviously one of the reasons why perhaps household spending has not been as strong. And they say that may be due to the fact that interest rates have gone up slightly faster, quicker here relative to in Europe, certainly. And that might have hit household spending. But they also think maybe it's sort of bleaker UK prospects. So people are less willing to dip into their savings because they want to hold on to their money. Now, I don't think there's anything definitive out there. And the data has been revised quite a lot. But I think you're probably looking for a combination of those factors for what seems to be the UK relative underperformance. But as I said, really interested to hear what Jonathan and the rest of the panel think.
I'd agree with all that. And I would just add that the other factor is on the supply side. You know, those are mostly sort of demand side factors. On the supply side, of course, we have this issue with the fact that the UK labour force is the only one that hasn't recovered to pre-pandemic levels as well, due to a rise in inactivity, which in turn appears to be related to a rise in sickness and disability. Although unpicking exactly how all that works and what is causing what and the extent to which it's driven by the pandemic and its after effects, by the issues in the NHS and by more general labour market factors, I think it's far too early to tell, but I think that's certainly quite worrying. And I think the sort of my view of the bigger picture is, the UK is doing, Europe has clearly been worse affected than other regions of the world economy by by what's happened over the last year, and the reasons for that are obvious. Within that, the UK is doing slightly worse. It's not massive, but it's it's probably a bit Brexit and a bit the other special factors that Ben raises. But more broadly, I think sort of what seems to be happening is that it's gradually sinking into public consciousness of just how bad the past 12 years have been for the UK, that really we have had pretty mediocre economic performance. And this isn't just about Brexit, obviously, because it really is about the last 12 years. So you see this sort of increasing realization that we have a sort of long-term problem. And of course, as I think all of us have in one form or another said, Liz Truss was in some sense asking the right question. She may have had very much the wrong answers, but the sort of question as to, why has the government of which Liz Truss and Rishi Sunak and others have been a part delivered such mediocre economic performance for so long, and what can we do about it, was indeed the right question.
Jill or Gemma?
Just a couple of things to sort of add to and draw out from what Jonathan and Ben have already said. I think the UK sort of experienced a double whammy of things that have only hit other countries, kind of one or other of them happening. So as Ben said, one of the factors affecting the UK is the negative impact of high energy prices, and particularly for households who spend a lot on gas to heat their homes. That's something that other European countries have been very subject to as well, because also very exposed to oil and gas imports from Russia. But the US, for example, has been less affected by high global energy prices because they're much more self-sufficient in gas production in particular. But the UK has also, as Jonathan said, had problems with a very tight labour market, a lot of people moving into inactivity after the pandemic. And that's a problem which the US has experienced similar issues. So it has a very tight labour market at the moment as well, but that's been less of a story in continental Europe. So the UK has kind of got both the energy problem and the labour market problem going on. I think the point that Ben mentioned on household savings rates in the UK, so the fact that savings rates have remained high and households don't seem to be spending down their assets as quickly as is happening elsewhere, is quite an interesting point. And how that might play out in the next year or so, because we've had in the last month or so, both of the big official forecasters in the UK produce forecasts for the next few years, in the Bank of England at the beginning of November, and then the Office for Budget Responsibility presented its forecast in the middle of November. And one thing that was really striking in the contrast of those two forecasts was that the Bank of England was much more pessimistic about growth prospects than the OBR was. And one of the things that the OBR highlighted as a reason why they were more optimistic about growth next year and beyond is because they think households will start spending down their savings to a much greater degree, and so supporting economic activity. And so if they're right, then we'll start to see that savings unwind, and that will help the economy. But if the Bank of England are right and they keep holding on to their savings, then that would actually be much more problematic.
Yeah, I was just going to make the same point as Gemma about the importance of that savings ratio for the future prospects, given the difference between the Bank of England and the OBR. I mean, just a couple of other things that might be affecting the UK, but these are just unthought through hypotheses, and everybody feel free to shoot them down. One of which is, I think the government's done a really bad job in communicating the nature of its energy support to people. And I just don't know whether other governments, I have no evidence for this at all. Energy bills are obviously less salient if you live in well-insulated housing stocks. And we know the UK is very poor at that and is very exposed to gas because we depend on it so much for gas central heating. But I'm not convinced the government has actually really persuaded people about the extent of the support they're giving, and therefore I think people are still worried about what energy bills they may face, notwithstanding that's very substantial support that's coming through. And I think that was sort of slightly because that became sort of quite a big issue in the leadership election, with different plans coming out. And then when the government announced its first big package, was immediately overshadowed by the death of the Queen, and then overshadowed by the chaotic mini budget. So I think if you wanted to really communicate that very effectively, the government's done a pretty terrible job at communicating something that's quite difficult. The other thing, and this is where I'm very interested, I don't know if Jonathan or Ben or Gemma have views, is whether there's a bit of a function of the income distribution in the UK, that we may be combining the fact that we have a lot of sort of relatively well-off-ish people who are the people who saved a lot during the pandemic and who, you know, maybe a bit worried about their energy bills, but are sitting on their cash. And then at the other end, we have a lot of people who really are feeling the cost of living hit very substantially in their pockets and are sort of nervously trying to make ends meet. And that's one reason why you see this odd juxtaposition of people who seem to be really struggling to pay bills and then people who are not dissaving, because you might imagine if you had a sort of perfectly equal income distribution that everybody would react the same, but you could see that in this sort of circumstance people might react very differently. I think the other thing that will be inhibiting people is just the sort of, you know, gloom and uncertainty about the future economic prospect, which doesn't make you think, oh, things are going to be so much better next year. I will act with a huge amount of consumer confidence.
Interesting. I mean, Jonathan, just to pick up on, I mean, you said people are coming to realise how bad the economy has been for the last 12 years. I imagine 12 wasn't a random number you plucked from the sky, but is one thing that's quite interesting is you hear a lot of chat now about these problems being sort of very long term. That is to say, our productivity problem is not new. It's often talked about as if it's new, but to what extent are the sort of problems we're facing partly the result of these kind of longer term issues, particularly the lack of productivity growth, and to what extent have these been sort of very long term factors?
They certainly have been. So, I mean, in particular, productivity growth has been extremely weak since the financial crisis. We don't entirely know why, although it has something to do with low business investment. It has something to do with low public sector or poorly managed and planned public sector investment. It has something to do with austerity and in the general sense, and probably something to do with the not particularly well functioning nature of the UK housing market. All of these are sort of long term problems. But I mean, most of I think most of what's going on right now, of course, is very much cyclical. And as we've said, it's not that we are that different from other countries in Europe, but that comes on top of these sort of long term problems. And as we come out of this, we need to think what to do about those long term problems. And some of these problems go back even farther. I mean, I think one interesting thing about the rise in sickness and disability and the impact on the labor market is to compare what happened in the recovery from the 1990s recession, which we now think back of as, oh well, there was this terrible mess with Black Wednesday, and then actually the government put in place a quite well-functioning macroeconomic framework for 4 years and then handed over a reasonably well-functioning economy to Labour when they were elected in 1997. And there is a lot of truth in that from a macroeconomic perspective. But what that misses is that there was actually a huge rise in the number of people on disability benefits after the 1991 recession. We went from a million to an extra million people on disability benefits, and I do wonder whether and we're in danger of repeating that mistake right now.
Does anyone else want to chip in? You don't need to. Anyone on this longer term issue?
I mean, just to pick up on that last point Jonathan was making, I think it's a really interesting one to reflect on, because when I started my career in the early 2000s and I started work looking at employment of older people, and even then there was still very much a focus in policy discussion and policy setting around how do we encourage more older people into work, exactly addressing that problem of large numbers of people in their 50s and 60s sitting on disability benefits or moving out of jobs into early retirement on early drawing of pensions. And actually I think over the following kind of 15 years, that problem almost got solved. We actually had huge increases in employment rates of those groups and big declines in that sort of legacy of lots of people sitting on disability benefits, such that I think probably attention had kind of shifted off that as being a really key policy concern, and maybe we need to slightly go back to thinking about some of those issues and some of those policy approaches that were actually very salient and we had a lot to say about in the early 2000s, but perhaps became less important.
Well, actually, while we're talking about possible solutions to some of our economic issues, the Brown report obviously came out yesterday and contained a lot of ideas that have been framed explicitly as responses to sclerotic economic growth, to regional inequalities and so on. I don't know to what extent any of you have managed to sort of peruse the report in all its glorious detail, but were there ideas in there that made you hopeful? I mean, are you, for instance, amongst those who think that the sort of devolution that's talked about in that report is a way of stimulating greater economic growth?
I mean, I'm happy to start, and I'll say I'll give credit to my colleagues who were pouring through the Brown report yesterday. I can't, so I'll draw heavily on the insights they managed to pull out of it. I think a couple of things that sort of stood out is it was interesting how much the diagnosis and almost the prescription was really similar in the Brown report to the current government's approach on levelling up and views on devolution. So the Brown report very much kind of focused on this need for constitutional change being justified by weak economic performance, poor regional growth, and using devolution of powers and constitutional change as a way of addressing that problem. So interesting that perhaps scope for sort of agreement across the political spectrum, and it's been one of those areas of policy making where we've had loads of churn in different institutional structures and different policy approaches, and maybe there's a bit of kind of agreement across the board now on what is needed that might give a bit of stability to that direction of travel. I think the sort of will it work? I think probably the academic evidence is a bit patchier than perhaps the sort of political consensus is about this link between devolution of powers and stimulating economic growth. So probably needs to be a bit kind of realistic about how much simply changing where decisions sit is really going to stimulate growth. But I think there is evidence that if you put the powers, spending authority, the decision making at the sort of appropriate level for different types of policies, that can have an impact. And so there probably is scope for devolving responsibility around skills policy, transport policy, and innovation policies down to a lower tier of government, but need to be careful. That's kind of, you do that to the right level, you can get too micro and lose some of those synergies that you need to sort of set policy at an appropriate level.
Yeah, can I just come in, Anand?
Yeah, absolutely.
Yeah, I mean, I think there is a kind of consensus, as Gemma suggested, that there are potential macro productivity gains to be had from the whole levelling up agenda. That if we brought our big cities in the north up to a higher level of productivity, that really would make a difference for the overall economy. In terms of how you get there, I mean, I sort of feel like I've been covering levelling up for so long now. I mean, I haven't read the Brown report, but my sense is that talking to people who really have studied it in great detail is that you need things like infrastructure, you need things like better skills, but to sort of the secret sauce, if you like, the way to pull it all together is through a greater devolution of power to people who are closer to the particular problems of particular areas and the challenges, and so I think, broadly speaking, that it does seem to make sense to devolve, as Gemma was saying, some of those powers over transport, over skills, to a lower level. So I think most people would, most experts I sense would agree with the general thrust that you can get productivity gains through a devolution agenda, and it's the key is delivering it. As Gemma said, there's a kind of consensus. There's very few people who will say, well, centralization is the way to level up or to improve productivity in parts of the country where it's undershooting its potential.
Just to be clear, when you're talking about devolving powers, you're talking about devolving cash as well, aren't you? So it's not just...
Yeah, I think it's devolving the power to spend higher levels of investment in those areas. And just on the point Jonathan was making before about why the problem of the last 12 years, I think it is interesting to note that if you read Rishi Sunak's Mize lecture from earlier this year, of course, when he was Chancellor, it basically came down to his diagnosis of why we've had such low productivity growth. In his eyes, was really a story about low investment in government and private sector.
No, absolutely. All right, we've got loads of questions coming in. Actually, I'm going to ask, there's a quite a techie question that I want to put to you and see if anyone's, which is that people tend to be generally very bad at measuring services productivity. And is our productivity, is our productivity higher than we think because we're a services economy and we tend to underreport productivity in services? Is that a fair claim? I'm not going to put that to anyone in particular. You're all looking.
I'm not sure I would categorically say that. It is difficult to measure productivity in services, and there's a sort of disentangling where the value of output has gone up, the extent to which that just reflects a price increase or a genuine increase in the quantity of what we're doing. And there have been some big changes to measurements in the recent past where the ONS has decided we've kind of got it wrong in how we valued outputs, particularly in telecommunications. The ONS recently did a big upwards revision to estimated output and productivity in that sector because they judged that actually we'd been getting more value out of what the sector was doing, whereas they'd been counting sort of increases in mobile phone contracts, for example, as increasing price. And actually they decided that more of those price increases reflected genuine increase in what you were getting for it, because your mobile phone is delivering a lot more service to you these days than it used to. So there are definitely areas where it's very hard to measure. I'm not sure I could hand on heart say that definitively we're definitely much more productive in those areas across the board. There could be areas where it goes exactly the opposite direction. I have to say I've always been slightly skeptical about some of the measurement of productivity in the financial services sector based on charges for those services, which don't necessarily seem to tally up to genuine economic output.
There was also some real weirdnesses, I think, wasn't there, during the pandemic, with the way in which productivity in public services was being measured. And that was, people were saying that was one reason why the UK looked as though our productivity had fallen so much further, and then sort of our GDP fell so much further and then bounced back, was because we measured things in a different way to other countries if you compared with other OECD countries. And it's definitely much harder to measure productivity on services and public services. The ONS has been beavering away on that for ages to try and work out how you can measure productivity in public services, not just looking at inputs and things like that.
Brilliant. I just want to sort of look back briefly. There's a lot of, unsurprisingly, questions about Brexit that we will get to sooner or later, but I want to go back to the mini budget. I suppose the thing that interests me is, is that done with now? I mean, did that, in the end, was that the sort of, did that have serious long-term implications for the British economy, or has Jeremy come in and basically righted the ship and everything's as if it never happened? What is there a scarring? Are there long-term reputational or other consequences for the UK that are economically significant, do you think?
Well, can I come in? I'm not going to do on the economic significance. I'll leave that to the better economists on the panel, which is everybody except me. But I do think there's sort of quite important institutional scarring, if you like, which is that the ironic or paradoxical impact of the mini budget and the sidelining of the OBR, the sort of dismissal of Tom Scholar and the Treasury, and the rubbishing of the Bank of England. I mean, the paradoxical effect, I think, is that subsequent governments are having to be much more cautious about those institutions and will be a bit hemmed in how far they can be seen to take them on because of the effects of the sort of market reaction to so blatantly deciding that they were going to deliver such an unfavourable verdict on the Truss mini budget that they had to be ignored. So I think that is one of the sort of longer run effects, even as the sort of interest rate premium on government debts disappeared. I do think you've got that and sort of reassertion of faith, whatever. And I think it's almost scary how much governments, at least in the short run, seem to depend on Richard Hughes's verdict on what they're about to do, because there are varieties of views and assumptions available.
So you're saying Treasury orthodoxy is back?
I think that that economic, those sort of independent institutions have received a sort of big shot in the arm from the people who chose to take them on. And insofar as they embody whatever we mean by Treasury orthodoxy, I know Gemma's doing some work on this at the moment to talk about that at greater length, insofar as they're seen to embody a sort of orthodox thing. I'm not sure. I think there was a bigger than just Treasury orthodoxy. I think that the Laffer curve was well and buried back in the 1980s and things like that. So I'm sure there's agreement among that beyond just in sitting in Horse Guards Road in the Treasury.
I mean, I would say that the danger. I think the sort of short-term economic impacts have basically gone. There's not really very much left. As Jill says, that the spreads have basically gone back to where they were. The pound is back to where it was pre-Liz Truss, before it became clear Liz Truss would become prime minister, etc. The risk, obviously, it seems to me, is that the UK used to have this reputation as being a boringly stable place with very strong institutions and strong consensus on some elements of macro policy across the main parties. That is to say, a macro framework and a sort of prejudice towards free trade and free markets, but not sort of excessive, not a sort of Hong Kong style, but a sort of European prejudice at the one end of the European spectrum, prejudice towards free markets and free trade, and we've sort of steadily, as well as having good institutions more generally, not just economic institutions, but more broadly, the civil service, the way Parliament works, etc. And that has pretty obviously been very much eroded over the last few years, by Brexit, but more than by Brexit, by the way we handled Brexit and our system handled Brexit, as it were. I think Brexit itself wasn't what did them, and then Liz Truss and then sort of came in and sort of put that on steroids. And the question is, how much damage have we done through that, and how do we recover from that in terms of international credibility more generally? And it's not just, so it's not about gilt yields per se, but our ability to run a decent economy. I've occasionally been accused of being sort of slightly stereotypical about this, but I've been saying for some time that the danger of Brexit was not that it would lead to some sort of catastrophic car crash, but it would lead to the UK looking a bit more like Italy in terms of economic performance. And there is also a worry that we look a bit more like Italy in terms of sort of institutional quality, faith, reliability of government, and all the rest of it. And I don't think that is, as I say, with all respect to Italy, which is a great place, a wonderful place to live and visit. But with all respect, that is not a road which I think we want to go down. In terms of the sort of Treasury orthodoxy in the OBR, I think this is somewhat overstated. In the sense that, I think, as we've seen, governments can come in and make up pretty much any fiscal rule they like, and the market seem to be quite relaxed about that. So if the next, I really don't think the next government, whoever it may form it, should, feel, oh, I can't do this because Richard Hughes will tell me it's not okay. What the next government should learn is that the government should respect the role and independence and the function of the OBR. It doesn't mean that the government has to let Richard Hughes just dictate fiscal policy, because he doesn't want to. It's not his job, and it's not what the markets expect.
Ben and Gemma, I'll come to you in a sec, but just on the point you were making about governance, Jonathan, I mean, we've got a couple of questions here. I mean, one is saying that, in development economics, good governance is identified as a factor is there are you sort of saying that there's a danger that people are less certain about our structures and our institutions now, and that might ultimately play a role in how people view our economic prospects?
Yes, absolutely.
Okay, Gemma and Ben?
Go ahead, Gemma.
Not together, sorry.
I mean, just to roll back to what I think your original question was, Anand, about what's been the economic impact of Brexit. I mean,
well, the mini budget.
Of the mini budget, okay.
Yeah.
I mean, on that, I sort of agree with Jonathan. I think that there doesn't seem to be much evidence now of any kind of permanent impact on UK borrowing costs or sterling from that. On the sort of Treasury orthodoxy question, if we take Treasury orthodoxy to be that there is some kind of budget constraint on the government, I think that has been reasserted as a genuine constraint on policy, which Liz Truss and Kwasi Kwarteng were sort of trying to duck. And I think you can see in the way Labour has approached things since that they don't seem to be at all inclined to challenge the idea that there is some kind of fiscal budget constraint, and that they would put forward fiscal rules and a plan for government that would be somewhat consistent with at least not having an explosive debt path. But I don't think we've not had a complete kind of swing back to really tight fiscal constraints and a kind of complete imposition of some sort of view of the government as being a household and having to pay back its debt and things. Like, if you actually look at what Jeremy Hunt announced on the 17th of November, we've got a set of fiscal rules which are substantially looser than the ones that he got rid of, both in aiming for a higher level of borrowing than we previously were and allowing ourselves 5 years to get there rather than 3 years. And also setting out set plans with very little headroom against the new fiscal targets. So I don't think there's not much evidence that this is a government that feels incredibly constrained by that kind of orthodox view of the budget constraint. It's clearly accepting that there is a budget constraint and making those kind of reassurances to the market, but they haven't particularly gone very extreme on that. And for example, there was a lot of discussion in the run-up to the autumn statement about what would the new forecast look like, what would be the size of the black hole, precisely how many billions did they need to fill. And actually a big part of the answer on the day was that Jeremy Hunt decided he really didn't need to fill all of that hole that there was in the public finances. A big part of his response was just to say, we'll happily have a higher level of debt and borrowing than we thought we would 6 months ago. So I don't think we're kind of in a really extreme Treasury orthodoxy world at the moment.
Ben, did you want to come in?
Yeah, I mean, on the sort of the political economy legacy, I suspect that we're not going to have unfunded tax cuts, large unfunded tax cuts presented as a growth strategy by any government anytime soon. And I think for good or ill, I think the libertarian economic wing of the Conservative Party are not going to be in charge again for some time. So that's a big impact of the fallout of the mini budget. I think, on the sort of direct financial impact, as Jonathan and Gemma have said, UK gilt yields have come back down to broadly where they were relative to other countries. I would say though that mortgage rates, which is of course what most people experience the financial markets through directly, or one of the ways they most directly feel it. 2-year and 5-year fixed rates were 4.75% on the day of the mini budget. They got up to 6.5% in the weeks following. They're still at around 6%. So you would have expected them to go up probably a bit anyway, but probably not by that much. So you're still seeing the legacy there of the mini budget, which is directly affecting everyone, of course, who remortgages. So that's a direct financial impact. Now, so those have gone up like a rocket and they're falling like a feather. The hope is that the fall will accelerate, but it's not much consolation that they're going to come down maybe in 6 months' time if you have to remortgage tomorrow. In terms of the sort of the longer term institutional impact, it was striking when I was speaking to sort of bond investors after the mini budget. I said, why has there been such a dramatic reaction? What's the story here? Is it the unfunded tax cuts? Is it the institutional tax? And one thing that kept coming up was we just can't see a good story for investors about the UK at the moment. And they actually quite a few of them brought up some of the points that Jonathan was making about 12 years of this. It was almost like, you've given us 12 years of massive current account deficit, weak growth, and now you're trashing institutions. So it's the coming together of all that historic failure and also the current sort of attack on institutions. And I think the episode, although in financial market terms, as I was saying, it's broadly back to where it was, I think that will leave a scar, and it probably will leave us more vulnerable, if we do in future have these similar kinds of episodes. I think the danger is that we might have lost the benefit of the doubt in the eyes of financial investors. Who knows how bad the impact of that will be, but I think that is a concern.
But at the margins, it constrains us that then, more so than we would have been constrained before.
Well, I think in the minds of policymakers and politicians, it probably does, and that may or may not be a good thing in terms of how much we can borrow. We might come on to this, but I don't think it directly will. But in terms of the restraints that people and policymakers feel, yes, I think so.
And Anand, I think that there's probably there's generally a sort of problem with political instability. If you look like your major governing party that saw itself as the natural party of government is incapable of offering very stable government. And I think there's also a bit of a piece building on what Jonathan says about the quality of policy making, where you see, the benefits of the UK system used to be that we had a sort of very unfair electoral system, but it delivers sort of, what Theresa May might term strong and stable governments that could basically offer you relatively predictable agendas and would get their policies through. And we've seen in the last week 2 quite big U-turns. One, you might say, a surrender to the anti-growth coalition, or whatever Liz Truss called it. One of which is maybe a handout to the pro-growth coalition. I don't know what Simon Clarke names himself as with his onshore wind, but we do see sort of quite a lot of sort of policy yo-yoing. So if you were asking the question that sort of people Ben was talking about, given all the places in the world you could send your money, and Rishi Sunak himself admitted that Brexit and uncertainty about the UK's relationship with the EU had deterred investment between 2016 and 2020. But if you had a choice of where you put your money, why would the UK come top of your list as the best bet? It's not clear to me what the investable proposition would be. That sounds a bit Dragon's Den, but no.
There's one specific question. I want to come on to the fiscal constraints in a second. One specific question coming out of this conversation is, why have mortgage rates stayed high if the markets have recovered from the Truss legacy? Why are mortgage rates still so high, given what you've all just said?
Well, if you speak to the mortgage lenders, Anand, they sort of say that we are going to bring them down. It's just that it's going to take a bit of time. And whether that's a satisfactory answer or not, is very questionable. And maybe are there competition issues here? I mean, I think in fairness to them, they might say, we've had a period of uncertainty, and it's only for a business proposition, it's only rational that we let things adjust before we bring the rates down. But I think that's what they're saying. They're saying that they will come down. It's just going to take time.
Maybe they'll do that when they get around to putting savings rates up. Who knows? But just on the fiscal constraint, I mean, this is the moment to mention. I mean, Robert Peston did that tweet today about the government having run out of money, which I know annoyed many economists. But there are sort of several bits to this, I suppose. Firstly is, how does the government know how much fiscal headroom it has? I mean, do you sort of suck it and see? Do you just have to put forward some ideas and see how the market reacts? How does that work? I'm sorry for being such a crass non-economist. And the second relates to the strikes we're facing in this country now, which is you hear a lot from government ministers about how wage rises that keep up with inflation will add to the inflationary pressure on the country. Is that true? Is that a sensible economic argument that actually, I mean, Jonathan hinted earlier that actually retention in some professions is as crucial as anything else to keeping the economy going? So how does all that play out? That gives you a lot of scope to talk about anything you want, I think. Go on, let's have a volunteer.
I can have a start. So I think it's unhelpful to think of, to your sort of first question about has government run out of money, it's unhelpful to think of government as having a kind of fixed stock of money and it's spent a load on the pandemic, for example, and we therefore can't afford to spend any more. And if anything, we have to pay back that debt that we've racked up. That's definitely not how government operates. The sort of, to the extent that there is a financial constraint on government, I think it's much more helpful to think of that in terms of government can predictably raise a certain amount of money through taxes every year. Exactly how much depends on obviously the design of your tax system, and use that money to pay for the things that we want to have. So services, welfare benefits, pensions, but also the costs of servicing the debt that has gone before. Governments, unlike households, would expect to get richer from year to year, so you can borrow some money and afford to service that debt in future. The thing the government can't do, I would say, is to be in a position where your stock of debt is getting bigger and bigger every year relative to the size of your economy and relative to the size of the tax take that you have. And the reason you can't have a sort of ever expanding debt is that if you do have that, then year after year, the amount of money that you have to pay to service that stock of debt gets bigger and bigger. And effectively, you'd get to a point where you're spending your entire tax take just servicing the stock of debt that you already have and having no money left over to pay for the things that people actually want in public services and welfare and pensions. So I think that's the kind of the constraint that there is on government, is not being on an explosive debt path. You asked the question, how do you know how much you have? It's definitely more an art than a science, because the constraint is really dictated by how quickly do you think the economy is going to grow? What does that mean for how rapidly you think your tax revenues are going to grow? And how are the demands on public spending going to evolve alongside that, which depends on things like the health of your population, income levels, income distributions, all of which is extremely uncertain. So there's a sort of art to it of forecasting where you think you're going to be, appreciating the uncertainty around that, and then building in some headroom in your plans. So you would expect to have a sort of more than 50% chance of being in a sustainable position in the future. But it's pretty hard to know. And I think, as we've already been discussing, in terms of the market reaction and people's willingness to loan you money, that partly depends on precisely what are the plans that you've set out, and partly it depends on giving investors confidence that you are a government that thinks fiscal sustainability is important. So if things go wrong, you will do something to get yourself back on track and mean that you actually repay your debts in future. If people lose confidence that you're actually going to repay your debts, then they'll be much less willing to give you money to spend now than they might otherwise be.
I think that last point is really important. This idea that you have to sort of, that to fund a new spending pledge, you have to raise a tax, which oppositions end up feel that they're sort of obliged to do is just nonsense. What you do need to do is to be credible, and to say that to have a strategy that looks fiscally credible and sustainable, to have an institutional framework which gives some confidence that you're telling the truth about it and that what you're saying is credible. That's the OBR, and to give a convincing impression, as Gemma said, that if things go badly wrong, you will do something about it, and that you will change course if necessary to put yourself back on a fiscal. And if you can tell a credible story about all those things, then the precise numbers or the precise specification of the fiscal rule is much less important. So I think that's in the sense in which that fiscal policy is constrained. It's not constrained by it therefore is, as Gemma quite rightly said, it is much more an art than a science. There are no, the idea that 60% of debt, as in the Maastricht limits, or 90%, as in Ken Rogoff's era erroneous spreadsheet, or 100% because it's a round number, is some sort of magical threshold, is just nonsense. It's about having a credible fiscal strategy that is reasonably robust to unexpected events. So that's the first point. The second point,
just quickly, Jonathan, and these fiscal rules basically then are a way of signaling credibility.
signaling that you're serious about it, that you're having some degree of external independent scrutiny, and that if things go wrong, that you will change, that you can credibly promise that you will change course and adjust your course if necessary. I think on the Peston thing, the thing that particularly annoyed me, and about some of what government is saying, is the idea that when inflation is running at 10%, when private sector pay is rising by about 6%, that the inflation problem is driven in any sense by the public sector, where pay is rising by about 2.2 or 2.4%. It just simply, as a matter of basic common sense, just doesn't compute, right? There is no sense in which so there are these longer term questions about how do we fund the public services we want, and those are serious questions and are constraints. But the idea that giving public sector workers more at a time when their pay is running way behind the private sector is in any sense going to fuel a wage price spiral, which is the sort of back to the 70s concern, that just doesn't make any sense. And obviously Peston was just transcribing what he'd been briefed by the government, but nonetheless you shouldn't report that in a way which sounds like it might in any world make any actual sense, because it obviously doesn't.
Brilliant. Ben or
Anand, can I just come in? Just picking up on what Jonathan said, I think even if it was a driver in some ways, I think it's a question of what's the right instrument of public policy to control inflation. Should you be trying to do it through public sector pay settlements and using that as the way to keep it down? Or actually, is it the Bank of England's job to control inflation? And the role of setting public sector pay should be with a view to retention and recruitment and delivering the quality of the public services you want. Should you be muddying the waters by telling public sector pay review bodies to consider things like inflation, which they actually are told to consider at the moment, as well as the affordability of any pay settlements within the envelope which the government set long before we had this unexpected spike in inflation? I think that's quite an interesting area. It's a bit technical, but should the public sector pay review bodies just be told to focus on retention and recruitment and delivering public services at the standard we want, and taking out all those kind of macro and government finance considerations? I think that's a really interesting, and I think it will be a public policy area which comes into a bit of focus.
And of course, it does seem to me, I mean, I'm an outsider to this, so I don't follow the literature or the debates, that there's a lot more time being spent discussing the relationship between health and economic outcomes now than was the case a few years ago. That's to say, we've touched on it in our discussions here, that actually having a healthy population is probably quite important to having a well-functioning economy. So you can't neatly separate them, even if you wanted to anyway. Jill, did you want to?
No, I was just going to say, actually, on that, I was a respondent at a debate that the Health Foundation convened, where Andy Haldane, former Chief Economist of the Bank of England, made a big pitch that actually we should regard health as a sort of important source of value in the economy, an important sort of factor in productivity, and that clearly it went down well with the Health Foundation audience anyway, and therefore you need to sort of invest a lot in health, because actually in the longer run, you paid a big economic price if you didn't keep the workforce healthy, et cetera, et cetera. So I think there is quite a lot of focus. There is, Jonathan said, we don't really quite understand this drop off in the labour force. I mean, there are some people saying some of it is related to people maybe who sort of dipped out of the labour force already, but then get more chronic illnesses or whatever, or can't get treated, can't get onto an NHS waiting list. So they're really interesting interactions. Of course, I mean, the main reason why the government's worried about pay increase in the public sector is that for any sort of budget, if you pay is a huge element in most public sector budgets. If you raise that, then you will, aside from potential retention benefits and reducing agency workers and things like that, but you assume that means you'll get less volume of output for any given cash increase, and down the line, unless there are very strong links into higher economic growth, you will have to raise taxes a bit more down the line to pay for those ongoing public services, and government wants to keep that down. But whether those giant differentials between public and private sector pay are at all feasible to sustain in the long run is quite difficult So we'll see what happens to the labour market. Recessions are usually quite good for public sector recruitment. So,
I mean, academics would, of course, produce more if they were paid more, but I don't know about other sectors of the economy.
that might not be good for the economy, though, Anand.
There's a question about housing. I mean, the general question about housing is how important is housing and the sort of housing crisis to the state of the economy, and what can be done about it? I don't know. I mean, it's a massive question, but is housing significant in this sort of overall macroeconomic picture? And the state of the housing market and the lack of house building? I'll put that to you merely as it's on Slido.
Well, I don't know. I mean, I'd defer to Jonathan and Gemma, but my sense it is pretty important in some ways. I mean, the ability of people to move around the country to where there are jobs is constrained if you've not got housing supply where it's needed and where people want to live. It's obviously a big part of people's incomes as well. If you could reduce the share that goes on housing, that would free up their income for other things. It's obviously incredibly important for people's quality of life. It's important in terms of investment in, expenditure on houses big enough to be a big driver of overall investment as well, just in overall demand terms. So I think on pretty much every front you look at it, it's important. I've not got any data on exactly how important, but I think it would figure pretty highly on all those metrics.
And it feeds into the other debates, doesn't it? I mean, I was always struck when ministers used to talk about how wonderfully flexible our labour market was, that, you could never recruit a mid-career academic from the north of England to come and work at a London university, because they take one look at the housing market and say, we can't make this work. So there's all sorts of dimensions. Jonathan, were you about to say something when I interrupted?
Yeah, I mean, just to agree with Ben. So, clearly housing affects the short-term macro prospects, because when people move, they spend money. House building is a source of output, and all the rest of that. And then house prices also do affect people's wealth to some extent, and that affects spending. So we know all of that. I think, like Ben, my instinct is that a dysfunctional housing market, by reducing mobility, as you said, and by making it harder for people to move to jobs where they would probably be more productive, and harder for firms that are in the most productive places to hire people, has a longer term, that there are longer term supply side consequences of the housing market not working well. But I also have to admit that it's very hard to quantify those. So I think there's a sort of general instinctive view among economists that a badly functioning housing market holds us back on the supply side and the productivity side as well. But we don't really know that much about how big that impact is, to be absolutely honest.
Jill or Gemma, either of you on?
I mean, housing is very weird, because, Jonathan and I worked at the Treasury together, and it is very clear that, although we can talk about actually the UK would benefit from having substantially more housing, lower housing prices, et cetera, et cetera, et cetera. If you talk to ministers, the thing that they're always worried about is house prices crashing, house prices going down. And so you've got this great, generally we don't like rising prices are bad, but because of this wealth effect and because of the links of that to consumer confidence, the leading indicator you're going to recession used to be movements downwards in house prices. So it's one of those ones where we're sort of caught in a bit of a trap. We all know what a better steady state would look like, but with significantly lower house prices, enabling much more mobility, et cetera, et cetera, et cetera. But actually the process of getting there was quite interesting. I think there was a poll in Paul Waugh's morning email, which asked people whether they wanted to see, a big fall in house prices. And I think 74% of people said yes, but actually, for all those people who actually, have got mortgages, risk negative equity, for people who own houses outright, see them as major source of wealth, or are using them to invest for their pension, things like that. Those wealth effects are not, do have macroeconomic effects as well, if people then feel that they're significantly worse off because house prices have gone down. So you have to remember both effects in the housing market.
Gemma, did you want to add anything on?
I mean, I was only going to more broadly say, kind of broadening it out from housing to sort of the broader planning framework, I think is one factor that people do think is probably a constraint on UK economic performance more generally. It was one thing that Liz Truss and Kwasi Kwarteng highlighted as being one of the areas they wanted to reform, and perhaps there was probably more support amongst economists for the idea that that was a genuine opportunity for boosting growth, but just that the politics of it are so difficult, and certainly in a way they sort of approached it the wrong way round by doing the tax giveaways and then wanting to come back to the difficult question of planning reform. Whereas I think if you're going to tackle planning reform, you need to have some giveaways or some ways of buying off the losers to get that through Parliament.
It's that wonderful Jean-Claude Juncker quote, isn't it? We all know what to do. We don't know how to be elected after we've done it. Seems apposite here. We've got a huge number of questions here about Brexit, and I'll try and put them in some sort of rational and logical order. The first of which, I suppose, is given we've had COVID, given we've had the cost of living crisis, we have the war in Ukraine, how possible is it to identify the degree to which each of those plus Brexit is responsible for economic outcomes? Is it possible to disentangle these things, or is it something we'll need to wait to do in retrospect?
Well, I mean, I think, it's harder with something like GDP than it is with trade. So, what you need is a counterfactual. You need to compare what happened here to something else which would have been similar, and you have to construct that counterfactual by looking what's happened to other countries. But we saw that examples of that in, for example, the work done by our colleagues at LSE, looking at food prices, which looked at the extent to which foods where we relied more on imports from the EU compared to other food products, and how that changed around the time of Brexit. And they did manage to identify an effect. So using that sort of technique, you can do that. It's harder when you're looking at broader macro aggregates, particularly for GDP, but I think it's pretty hard to look at the trade data and not say, actually, the UK's economic performance since Brexit has been quite weak relative to almost all other advanced economies, and that is likely, at least in part, to be due to Brexit, and most more sophisticated analyses have come up with pretty much the same conclusion. So I think we can be reasonably certain that there have been negative impacts on trade, on business investment, and so on. You can argue about the precise magnitudes of those, but we are doing worse than other countries, and this is not just a COVID effect, or even just a Ukraine effect. It's not, and I can't keep on saying this enough, it is not the main driver of what's going on in the UK macroeconomy at the moment, which is broader, which is driven by energy prices and other sort of macro factors, but there is pretty clearly an identifiable negative Brexit effect as well. And similarly, actually, on the labour market, where things are quite mixed, but there are certainly, because of course migration has not reduced with the introduction of the post-Brexit migration system, but the sectors in which migrants are coming have changed quite a bit. So it's not clear actually whether that's an overall positive or a negative. But I think we can say that there have certainly been effects which are clearly attributable to Brexit, both positive and negative.
And does anyone want to come in on that broad point about disentangling the various things going on and their impact on the economy? I suppose, if not, my follow-up would be, how seriously do we take attempts to put a number on this? I mean, Jonathan, you hinted at the fact that we can debate this. The OBR famously says 4%, of which I think they were saying a certain amount is already.
We should be clear about what we're talking about here. So the OBR took back in about 2018, looked at all the serious, credible studies that had been done outside, independently, actually including the government one, of the impact, the long-term impact of Brexit, and basically said, on average, we expect the impact through the trade channel, not through other channels, not through migration, not through deregulation, because they look at migration separately, but simply but the impact via the negative impact on trade, we expect that to reduce UK output per head by about 4% compared to what otherwise would have been. That was a model-based, an average of a bunch of models prediction for the long-term impact of Brexit. It's not an estimate of what's happened now. And it will be very difficult. We will try and evaluate it ex post, but we will not be able to evaluate that for another 10 or 15 years. We should be clear about that. The OB has also said that about 1.5% of that negative hit has come through so far, and that's merely a sort of finger in the air. Look at all the data. What do we think roughly? How much of that damage has been done so far? The OBR's view is also that it sees nothing in the data so far to lead it to change that percent forecast. And I think that's not a bad, all of those judgments I think are reasonably defensible. They're not perfect, they're not scientific, but they're reasonably defensible. In terms of putting a number on what's been done so far, you can get, the attempt by John Stringford at the Centre for European Reform to construct a synthetic counterfactual, i.e. looking at other countries that performed very similarly to the UK in the run-up to Brexit. How have they performed since, and how have we performed since, comes up with a number of -4 to 5%. My view, and I think that of others, is that for various technical reasons, that's almost certainly an exaggeration. You have others, such as the Brexit supporting economists like Julian Jessop, who probably guess something more like 1%. My view, but again, this is a subjective view, not is that, but I think it's shared by others, like say Chris Giles. I suspect Ben and Gemma are probably in roughly the same territory, would be that 2 to 3% is not, or 1.5 to 3% is a sort of reasonable number, but it's not a science. Is that fair, you two? Because I've just put words in your mouth.
No, I mean, I would definitely agree on, those are sensible numbers. I think, but overall and on trade and on the GDP, I think I'd be much more comfortable sort of suggesting a sort of directional effect, actually, rather than specific numbers. Because I know, just looking at the trade data, you'll have seen, Jonathan and Gemma, you've probably seen as well, there is this debate about to what extent UK to EU exports have been hit. I think Thomas Sampson's stuff suggested not at all. Some other studies have come out I've been looking at recently suggest quite a large effect. And it depends, as Jonathan's been saying, on what counterfactual you use and what date you go up to. Some of the more recent ones saying it's starting to come through now. It's a pretty muddy picture, but I think, as Jonathan aptly summed up, the overall view, I think the sensible overall view is that it has had a negative effect. There's some interesting questions about how that effect has been created, the interactions of supply chains, rest of the world trade, EU trade, that we really need to find out more about. But yes, I think the overall consensus is that it has been negative, I think, on trade, and following on from that, GDP as well.
I think it's worth saying, though, I think even the Samson piece, if it's the right one that I'm thinking about, did say there's a reduction in the number of trading relationships. So even though the sort of numbers might look the same, the nature of that trading relationship has shifted.
Yeah, and particularly smaller firms. And I've just been I'm putting together a piece for Newsnight, which hopefully should run on Friday. We talked to a couple of small businesses, and it's really, I mean, they just take you through in the most excruciating detail about what happened to their trade the minute that we had exited the transition period, the bureaucracy and the impact. And you can just tell, why would you go through that if you were a small company without the resources to be able to throw at that bureaucratic task for relatively little reward, given their size. So it's very plausible that a lot of, as the data shows, that so many small exporters have left the market as a direct result. They may come back, but it's going to take some effort.
Gemma or Jill, either of you want to come in on any?
Only very briefly. I mean, as Jonathan Ben was sort of saying there, in a sense, is really hard and is always going to be very hard to sort of disentangle the macro effect of these things, because there have been so many things going on that affect the UK differently from other countries, and so much of the effort has been trying to look at the channels through which you expected these things to have an impact. So where you would expect to see an impact of Brexit, but perhaps not of COVID, for example. And just the other one that I've seen people looking at or pointing to as sort of one of the possible impacts of Brexit is looking at what's happened with the Northern Irish economy relative to the rest of the UK. And actually, it has been doing phenomenally well relative to the rest of the UK in a way that it hadn't done previously. And I think there's some, at least anecdotal, if not really hard evidence there, that that's because UK firms locating activity in Northern Ireland to take advantage of its dual position in the EU environment as well as being in the UK environment was one of the attractions there that has been lost by some other parts of the UK.
Okay. Jill? I get worried about you.
I think on unpicking, I mean, I think in a sense, one of the interesting things is that the debate about the Brexit effects is really getting going with a bit of a lag because there was so much conflation with the pandemic, which happened so soon after we moved over to trade under the Trade and Cooperation Agreement. But it would be a huge indictment of microeconomics if putting up barriers to trade like that had no impact on your trade, because that would be one of the sort of most certain results you would have assumed from basic economics, that if you make it much harder to trade with people, there will be a bit less trade at the margin than there would otherwise have been. And it looks as though that is happening. I think one of the interesting things in the trade data, and I'm not sure whether this has been substantiated elsewhere, was that it looked like EU exporters were exporting less to the UK, even though we haven't implemented controls at the border and effectively still recognise EU standards, etc. So that sort of battery that faces UK exporters trying to get into the single market doesn't face EU exporters coming here to anything like the same extent. But one of the things we do know is that before Brexit, one of the features, for example, of the Dutch Get Ready for Brexit campaign, which is very different from the UK one. The UK one focused on all the potential opportunities and benefits and didn't really warn business in anything like an adequate way that they were about to have a mountain of red tape dumped on them courtesy of Brexit. But the Dutch one said, take the UK out of your supply chain, they will have a very different, more distant relationship. So if you want to be sure about your sort of, business flows going forward, it would be better to avoid the UK. And there does seem to be a bit of that, I think, coming through as well on that decline. And I think there's a really interesting question of just how long this sort of asymmetrical relationship, in a sense, because of the constrained UK environment, bureaucracy, can sustain, where we run one system for the EU, which you can justify on ideological grounds, as Jacob Rees-Mogg and David Frost have done, or you can just do on practical grounds, versus our exporters facing genuine difficulties moving goods and services into the single market.
Okay, you can all guess where this one comes from, but is it credible to argue that joining the single market would not boost growth?
No.
Okay, I mean, Keir Starmer did hedge this slightly by talking about, the fights and the debates and the disputes that this would cause, but on the surface, it's just not true, is it?
That's right. I mean, I did write an article which tried to take what Keir said sort of, seriously, not that single market would be bad for growth, but that the either that the uncertainty would be bad for growth, or that he could achieve most of what he wanted to achieve outside the single market. And I think both of those don't really add up either. In particular, there's an asymmetry. There's an uncertainty of what Brexit deal we're going to get and where we're going to go is not the same as saying to businesses, oh, well, we might have a much better trading relationship with the EU in future if we can negotiate it successfully. That sort of uncertainty is not obviously going to damage investment. The prospect that things might get a lot better for some businesses. The second point was on that in terms of what he's proposing, I think some of what that Labour has sort of been hinting at would be extremely helpful, particularly in a context of Northern Ireland. Would be a degree of regulatory alignment, particularly on agri-food, would be from a political point of view, in terms of easing the Northern Ireland tensions, would be very, very helpful indeed. but macroeconomically, it's not such a big deal.
Yeah.
But it would be very useful for farming and agri-food producers. I mean, they're
Yes.
not a giant sector of the economy, so
Yeah.
you wouldn't shift the, particularly if that was a UK-wide alignment, that would, if you get UK-wide alignment there, then they are some of the people who are facing the biggest problems going in to there. I mean, of course, they're the other thing that they're desperately demanding, and Therese Coffey at the EFRA Select Committee yesterday was saying discussions are still ongoing between the Home Office and DEFRA on the numbers that they can bring in through the seasonal agricultural workers scheme, where farmers, I think you want around 90,000 people, and the government, I think, has in the past allowed about 30,000 people to come in under that scheme. So there are supply constraints there, but I think that is that would be a significant sectoral benefit, even if it didn't move the macro dial at all.
I mean, presumably being in the single market and not a member state is not as economically beneficial as being in the single market and a member state, because in the latter case, you get to play a part in setting the rules over that market, I would have guessed. I don't know if, I'm not sure I've actually seen anyone who's done a study of that.
Well, there's also the customs union, of course.
Yeah, no, absolutely. Gemma or Ben, either of you want to come in on this Starmer point about the single market?
I was speaking to a manufacturer up in Oxfordshire on Monday, and he's a medical devices manufacturer, and he sends things to Europe, and he says the situation now is that previously, when you were, say, going from central London to somewhere in Kent, you now have to go via Birmingham. That's how he described the impact of all the new bureaucracy that he has. So I was saying, well, what can make it easier for you to export to Europe? What practically can be done short of going back into the single market and customs union? He says, well, you can make it quicker to get to Birmingham through, I don't know, through making the bureaucracy easier to handle, etc., or investing in it, but you've still got to go to Birmingham. The only thing that can actually get it back to the levels of efficiency and ease, and therefore growing the market in the way that he previously has, was just to cut out that Birmingham route. And I think that's kind of I think there's a sort of element of truth in that reality. You can improve it, but you can't get back to where you were in the overall trading relationship, I would have thought.
I mean, Anand, if you look at it, Theresa May's Chequers deal was actually an attempt to get what you might say would be the sort of benefits of being a genuine member of the single market, where we actually thought there was very little advantage to the UK in diverging on good standards and things like that, where she proposed her common rule book, and where effectively a lot of product standards set internationally anyway, and the UK would never dream of using Luxembourg Compromise as veto to say we don't want that, while keeping services, in particular financial services, outside the single market, where actually there might be a UK economic interest in saying we want to do things very differently from the way in which an EU without a UK voice at all would do things. So, and I think one of the problems you see with a lot of the ideas that are being kicked around now is they do seem to be Chequers reheated, and there wasn't much appetite for Chequers back in when Theresa May dreamt them up in 2018, even if she should have got them through the party. They got a pretty firm sort of Black Forest Gatto back from the EU president then. Maybe we'd all be better off if Chequers had gone ahead, but I'm not sure whether there's that much of a market in Europe for going back to that. And that's one of the things these debates seem to miss, is where's the European incentive to give back bits that David Frost and Boris Johnson gave over to Europe by negotiating their very thin deal that prioritised regulatory autonomy.
I mean, we've got a couple of minutes left, so I get the impression I mean, I think one of you alluded to this earlier. We're starting to have that debate slightly belatedly now about the economics of Brexit. In a way, it strikes me that we haven't really beforehand. Do you think that's fair? And why is it because of the pandemic and stuff taking all our attention that this is happening now, or is it because people are living with the real world impacts, or is it because we're in the middle of an economic crisis and suddenly Brexit is now an economic issue, whereas previously it was some other kind of issue? Just striking, though, isn't it? I don't know if you agree that this debate seems to be breaking out in earnest, if not, I mean, obviously not amongst our politicians, but everywhere else. That's left you speechless.
There used to always be quite an interesting phenomenon, I thought. I remember doing a presentation on this to some people from the Hertie School in Berlin, that if you looked over quite a long time series, UK public hostility towards the EU was positively correlated with poor economic performance in the UK. So basically, the UK economy was doing badly, then we wanted to leave the EU, and it sort of brought us along or whatever. And I was just wondering whether the impact of Brexit has been to flip that. So when the UK economy appears to be doing badly, we suddenly look and the grass is greener over there, and actually maybe that EU wasn't such a bad thing all along. That's slightly flippant, but I think there may be an element of truth to that.
Well, we can't blame membership for our economic woes anymore, can we? So that changes the calculation quite profoundly, I would suspect. All right, we've got to 1:15 now, so none of the others of you have to respond to that. Can I just, before I thank you all, let me just end with a quick plug, which is that tomorrow, and I've forgotten the time unless someone can remind me, we have yet another event which
2 o'clock.
2 o'clock. Thank you very much. Jill, Jonathan and myself, along with Catherine Barnard, basically answering questions about the year we've just had in politics, economics, and anything else you care to ask about. You can find that on YouTube. But before then, let me thank Gemma, Jill, Jonathan and Ben. It's been fantastic, as always. I actually, at one point today, I think it was after your intervention about government spending, Gemma, I actually felt like I understood things. So congratulations. It won't last, but congratulations on that. And we hope to get you all together again at some point, maybe in the spring, to revisit these economic issues. But in the meantime, thank you ever so much and have a really, really good Christmas and New Year, if it's not too early to be saying that.